Okay, good afternoon all. Firstly, thanks very much for joining us today. The take-up on these analyst fireside chats has been pretty good so far, and we do hope that you guys are all enjoying the interactions. Also, we welcome any feedback. If there are any burning topics that anyone's really interested in, feel free to pop those through to us. We've got a number of analysts on our team looking at a variety of sectors and the macro, so please feel free to reach out to us. For those that didn't dial in last week or weren't able to listen to the entire session with Rees about the macro, you should have got a link to the recording yesterday. Please shout it if you haven't and we'll pop that through to you. Rees is also busy going through the various questions that came through that we weren't able to get through. So no pressure, Rees and team, but everyone should have the answers to those questions in the next week. Moving on to today, for those that are familiar with the format, we're going to spend probably the next 20-25 minutes just chatting in general about today's topic. We're going to leave a bit of time for questions. As always, those questions are encouraged. So please pop those through in the Q&A section or box that you see in your Microsoft Teams screen. I think we've received a few questions already, so we'll tackle as many of those as possible. Just a bit of admin as always, we are sitting on the public side as analysts, so no private info here. Our analysts are also all independent, so the views here are the independent analyst views, and we may differ in places from Nedbank's house view. So without any further delays, I'm going to move on to today's guest. He has been a regular on this platform, and I've always wanted to say that it makes us feel like we've got a little bit of a show on our hands here. But Walter de Wet is our macro strategist, and he's covered various asset classes over the years. I think he's gained a little bit of a cult following after his stronger Rand call at the start of last year. And if it wasn't a difficult enough task trying to call the Rand throughout the period of last year, this week he's tackled an even bigger task. He has written a note that tries to determine what the economic impact of COVID restrictions has been. So, a lot of information in here, a lot of data-driven conclusions that he's come to. So, I'm going to leave it to Walt to explain what this is all about. Walt, have I got that right?
Yeah, thanks so much, Harvey. Thanks for the introduction, and thank you everybody for dialing in. Yeah, you got it right. I think the title, and when you see the title, the cost of COVID restrictions, I think it might seem a bit stupid or elementary, because we kind of know the cost of the restrictions already, right? We've seen Q2 GDP last year contract by just over 50% on a quarter-on-quarter basis when you analyze it, and we obviously saw GDP bounce back quite heavily on a quarter-on-quarter basis in Q3. So we kind of know that type of cost. But the problem is, and what we try to achieve with this note is, we think we're at this stage where we cannot use the excuse that we don't have enough data to analyze these things in more detail. Of course, always, when we deal with statistics and econometrics and stuff, we want as much data as possible. But we do have almost 12 months of data now, and we think we're at the stage where we now need to start to determine almost what's the real-time impact of restrictions. Not look at GDP that comes available with a lag of 3 to 4 months and then say, oh yes, that was the impact. We can do it almost real time now, at least get an estimate, and that's what we try to achieve in this note. We want to do this for a couple of reasons. The first is obviously for our own analysis, and we focus specifically, as you've mentioned, on FX and fixed income. We're going to get a real time or at least a higher frequency estimate of what restrictions mean. We can immediately get a sense of what it might mean for the fiscal position for the country via tax revenue or expenditure that government needs to do. We also think, maybe we touch on it later, we can also use this type of data, or at least government should use this type of data more and more to use it in thinking about how they impose restrictions, should we need to do that again when there's a wave 3 or a wave 4 over the next 12 months. The last point I think I want to make is, it doesn't help. I think the data that we'll see over the next 12 months, obviously in years to come, economists will continue to analyze it and kind of get the real cost of the economy, because there's obviously longer term costs too. But for us living it now, that will be too late to do that in a hindsight way. And hence also why we embarked on this project, to get a real-time sense of what the costs are.
That sounds like a lot of work, Walter, and I'm sure a lot has been put in, but maybe just take a step back and explain to us how you actually do this. What is the stringency index you talk about?
Yeah, so I mean, I guess like many things in life, it sounds probably more complicated than it is, right? But one of the things that we've used, and we actually came about this data via the CIB, and it is the CIB showed this type of chart on one of their monthly chart exhibitions which they publish, and then we went and we looked at the data, and we realized that the Blatvanik School of Government at University of Oxford has actually been compiling data for all the restrictions across more than 150 countries since the 1st of January 2020, effectively when we realized there was a pandemic on hand. And they've compiled the sub-indices, and then it all rolls up into what they call the Stringency Index, which we show here. And what the Stringency Index essentially does is it gives us a sense, at least in numbers or empirically, what the level of, or the stringency of the measures in place was over time. And as you can see from the chart that we've just thrown onto the screen here, this is specifically for South Africa. In South Africa, there is the orange line, and you can see how our stringency index changed over time. Back in March 2020, our stringency was quite tight relative to the rest of the world. And you can see we've also got the max there, and we've got the least stringent index, and I've also put on there the average as well as the 75th percentile. South Africa very strict initially, and then we came off, and around about the end of the end of the third quarter, we dropped quite significantly as South Africa entered the summer period. And broadly, if you cast your mind back now, obviously South Africa saw the massive slump in GDP, and it all makes sense when you look at these empirical numbers relative to the rest of the world too. Where, as I've mentioned, a big slump in Q2 GDP, and then Q3, and it appears as if Q4 also is going to bounce back quite well. And as of the latest data is up until last week, and you can see South Africa is, in terms of its stringency, this is obviously the measures before President Ramaphosa relaxed it 3 days ago. We were pretty much in line with average stringency indices. Now, this obviously is great data. It comes out almost on a daily basis, and we can use that now to analyze some of this.
Okay, that's fantastic that we can see this on a daily basis, and I think everyone can sort of look at this and understand that we've lived through most of this chart for the last year. But Walt, how does this stringency index then translate into your calculations on the cost to the economy?
Yeah, and I mean, not wanting to do injustice to the process, but obviously not wanting to burden everybody with the process, but effectively, what we've done is, if we've got the stringency index, and we can get a sense of at what level we were in the past relative to now, because that's also one of the problems, right? So we see these restrictions being imposed on an economy, and it might feel worse, it might not feel worse than what it was, for example, in March, but we really don't know, and that has always been the issue. And we need to, if we can empirically identify at what level we were relative to the past, then we can at least, as I've mentioned, tie some number to it. And what we've done is we've used this daily data, we've transformed it into monthly data, and on top of that, we've got also obviously some growth figures from the economy already. And that is either quarterly, which we transformed, there's ways to transform it into monthly data, and there's monthly data that comes out as well. Then we've got a set of stringency indices, and we've got a set of economic data, and you can then start calculating, buoyancy rates or elasticities, depending on what you want to call it. Buoyancy rates we use quite a lot in, for example, fiscal policy, trying to calculate how tax rates would change or tax revenue would change relative to GDP. And we've done exactly the same type of thing here. How would growth, specifically in this context, change relative to the Stringency Index and relative to where it was in the past? And of course, as GDP comes out, we can obviously update it as we continue.
And Walter, I suppose the one thing that is probably on everyone's mind here is the efforts that government has actually put in to try keep the economy afloat. How do those stimulus measures factor into your chart and your data?
Yeah, so maybe just before we move to this question and just quickly talk, if we can just go one slide back to the one that just quickly want to highlight the numbers here, because I actually haven't mentioned it, right? So effectively what this chart shows is, we get to a number where we can calculate the cost per month of what the Stringency Index have on the economy, and which we call the gross costs, because, as you've mentioned, there's also economic support measures that's in place. Now, the slide that I've got here, the gross cost excludes that, and that is effectively, I would say, the cost of the economy. And you can see, back in March, if you look at these estimates that we've got, and we've cross-checked them with historic data, and it seems to add up, and it seems to make quite sense with what we've actually observed, and that's why we've got some confidence that it actually means something. Back in April last year, we estimated the gross cost of the economy, given the level of restrictions, was just over 40 billion rand during that month, and you can see how it changed. And when we went to October last year, the cost dropped quite significantly to just above 15 billion a month. And then now our estimates suggest that in January, the cost to the economy was around about 27 billion with these restrictions in place, which obviously talks to, if you look at where we come from in October, November, December, it talks to a slightly weaker growth outlook for the economy as a whole. And more important, what we can also do now is, once we get the latest stringency numbers from the Oxford University of Oxford, we can also get an estimate of where we think the cost for the economy in February will be. And so almost real time, and that's where we really think the value in this type of analysis lies, and should also be for government. Now, if we go to the next slide, maybe just to quickly answer your question. So what has been the impact of the government support? So we know there's various measures of support, and government has increased grants, social grants, emergency grants. There's been support to small businesses. There's also been some tax measures, tax relief for corporates and to some extent for individuals. Now, once we start taking that into account, the chart on the left gives you a sense of where we sit. And this is exactly the same chart as the previous one, except the gold, the light green, or the green goldish color shows you how the economic support measures actually subtracted from the cost. And then you can see the cost of the economy becomes quite substantially less. And especially once again towards the second or the third quarter of this year, and hence also why it makes sense that we saw such a large rebound. In January, to give you a sense, we think, as I've mentioned, on a gross basis, the cost of the economy was about 27 billion. If you take into account some of the economic support measures, we sit somewhere between 15 to 20 billion rand cost of the economy. So, about a third of the gross cost has been taken away by the economic support measures. On the right-hand side, same type of data. We just show it as a percent of GDP, because intuitively, I think for a lot of people that would make more sense. And you can see this is the cumulative cost over the period, and you can see what is happening there is at the end of January, on a gross basis, the cost of COVID restrictions, so up until effectively 3 days ago, the gross cost to the economy has been around about 12%. If you take into account the net, the economic measures, we sit at around about 7.8, I would say just below 8% of GDP. So that gives you a sense of where we've come from. Maybe I can also point out, if you take the gross cost or the net cost to the economy from January last year up until December, so for the whole year, it indicates that the cost to the economy has been around about 7.5%, which is not far off your GDP consensus contraction for this year of around about 7.3% for GDP over the whole of 2020. So kind of another check and balance that we can do to make sure that this data actually makes sense.
Well, I just want to touch on the chart on the left-hand side, the net versus gross cost. I mean, if we read this chart right, the stimulus seems to be relatively consistent throughout the months. It's just the obviously the gross cost that has changed. Is that something that ties up with what's happened?
Yeah. So exactly right. So well, time will tell, right? 12 months from now, I think we'll have a better idea. But effectively, why it is fairly steady over time is because a large part of the economic support measures comes through in the social grants, at least the ongoing cost, right? And when we think about the economic and support measures, as I said, that we all know there's a 200 billion fund that's provided, that government has provided guarantees towards, that's driven by the banks. When we look at these economic support measures, we think about the direct support, tax support or tax relief measures, as well as social grants. And that is why it's fairly steady over time. That is also why, if you think about, once again, how the economy has actually behaved, and when we looked at this, it actually makes more sense to us. We've had a very weak Q2 last year. And that's simply because the restrictions were so tight and the support measures were actually small. But obviously, because the support measures remain fairly constant, especially through the social grants, if the restrictions relax, it's got a disproportionate big effect on the economy, positive effect. And that's also why we saw such a large rebound and such a strong rebound, we think, in Q3 and Q4 of last year.
Yeah, makes sense. And then Walt, just looking at South Africa relative to other countries, I mean, one of the interesting things I saw in your note is that South Africa isn't terribly out of line with the rest of the world. I know when we sit here, we kind of think that the world's coming to an end given what's happening in South Africa. But just talk us through how South Africa compares to the rest of the world.
Yeah, so if we maybe move to the next slide. So exactly right. I mean, I think that is always something we need to do. And specifically, when we look at asset prices, like we do on a daily basis, because it is always the relative picture that matters, kind of from an asset price perspective. Obviously, in the daily life of people, it's the absolute measure. But this is, I guess, the kind of feel-good factor in that we've uncovered. How does South Africa stack up in terms of costs and restrictions? You've seen the first chart, right? I mean, the stringency indices, we've been pretty much in terms of our stringency in line with what the rest of the world has done. So our government, I think, was not necessarily unrealistic, although everybody across the world complains about restrictions. We've been in line. In terms of costs, if you maybe just look at the right, let's start on the right-hand side chart. We've done a comparison against a number of countries, and it wasn't a random set of countries that we've chosen. We've tried to use a few DMs, a few EMs, DM commodity producers, EM commodity producers, as well as trading partners such as, for example, the UK, to just get a sense of where South Africa is. And we actually end up, in terms of the cost, bang in the middle of these economies. And maybe just to explain that chart, effectively what it says is the scale tells you how much the economy is likely to contract if the stringency index goes to 100 and over the whole year, and this is on a net basis after economic measures. And for South Africa, we get a sense that if we run a stringency index for the whole year, with the economic support that we've had, which obviously is not sustainable for a whole year, or for another year, would I rather say. the economy would contract by around about 13%. Without economic measures, the economy would probably contract by around about 20%. You can also see at the two ends, maybe I should point out that too, because we have actually thought a lot about that. UK, Canada, it's quite a large cost on a net basis to these restrictions. And the opposite end, again, you also have Brazil and the US, which have a very little impact. And initially, we actually thought, and still to some degree, we think it is the case. Services economies tend to or are likely to struggle substantially more with restrictions, as we know. Your hospitality industry, services sector in general has had a hard time with restrictions. In the UK, Canada, large services sector. And the Brazil, the US, obviously, US got a large service sector, but also a large industrial sector. But I think there's also something else coming in here, which this data doesn't actually show, is that I think this also reflects how well countries have actually stuck to the rules. I've lived in the past in the UK and Canada and South Africa. And I know that the UK and Canada stick to the rules, right? And the UK invented the line, right? And they've exported it to Canada, and people stand in line for everything. And I think these countries just behaved substantially better. And we know that Brazil and the US, there was quite a lot of issues around the restrictions. And I think that's also playing into this. The Stringency Index actually doesn't necessarily tell you how well countries have behaved according to the rules. Long story short, nevertheless, Avi, I think the positive is, South Africa is not an outlier. There's definitely a cost, but it is not as big as we thought. And the left-hand side chart, I'll just touch on that. I'm not going to talk around that. That is just to put the cost in perspective. You can also see where the stimulus has come from. And this stimulus, I should just point out, the chart is, as I've mentioned, previous discussion point 2, this is direct fiscal spending as well as tax relief. It doesn't include stuff like, for example, guarantees and equity injections into the economy by a government. South Africa is once again round about in the middle of the bunch there.
Okay. So I suppose this is one time where following the rules has meant a bigger decline in GDP.
See, there's downside to following the rules, right?
Yeah. And Walter, am I reading it right that the UK has had a significant amount of stimulus being put into their system, but it's still being impacted quite negatively?
Yeah, absolutely, right. Absolutely. The UK and Canada, massive stimulus. I mean, their economies would have done substantially worse if it wasn't for the large stimulus that they've put in place. The US obviously also have massive stimulus, and Brazil as well, right? And I think that also speaks to the US and Brazil doing better. One of the reasons which I haven't mentioned, I think the US actually also did quite well because they actually did, as we all know, direct checks to individuals, which obviously resulted in spending from individuals into the economy. I guess similar to South Africa to some extent.
Also, I'm just having a look at some of the questions coming through, I think, while we're on the topic here, and I encourage anyone to send through questions. I'm sure it's generating quite a few questions on the audience side. But the question that's come through is just around other countries. How extensively can we use this data? I mean, the examples that are given here are Sweden, where obviously restrictions were very limited initially, and then the likes of Tanzania or any other African country where perhaps data is not as available.
Yeah. Look, I guess in terms of the countries we can cover and we can analyze, I mean, it's endless, right? I mean, we've used this smallish sample because we didn't want to focus on other countries, but certainly, I mean, Sweden, obviously, you can do that. I think there would be a treasure trove of data. I think actually even for countries like Tanzania and, if we're thinking about other African countries, effectively, at the minimum, you want 3 or 4 growth points. It's not ideal, but you would be able to do it. So to answer that question, you can expand this quite aggressively across many countries.
Okay. Great, thanks, Walt. And then, I mean, we talked a lot about the fiscal situation of South Africa. How do restrictions and all of your work that you've done here impact that picture?
Yeah, so maybe if we move to the next slide, it's look, ultimately this, and let me talk around the slide first, and then I'll make some comments around it. If you look at this chart, it's exactly the same chart as we've had above. There's just one extra line, and that is South Africa's long-term domestic borrowing since January 2020. And this effectively says this is the cumulative borrowing, and this is, I mean, this is not dollar borrowing. This is inflation-linked bonds and nominal fixed-rate bonds. And you can see that effectively the borrowing that we've done has covered the net cost to the economy. So we've actually been just borrowing to cover the costs. So I mean, it's not great, but we kind of know that already. I think what is more important is if you look at this chart, and what we've done, if you look at where the borrowing cost, the grayish line falls below the green line, the net cost to the economy. It seems as if the government is at this point starting to borrow too much. Domestic long-term borrowing is far starting to exceed the cost. If indeed, you know, we're trying to shore up the economy, which would be consistent of what we've been observing, you know, through monthly data and tax revenue, where, you know, we think from a fiscal perspective, from a national treasury perspective, Treasury can actually reduce their weekly auction sizes. I think that's one of the key things that we're observing here. We've actually been observing it since October last year, since before the medium-term budget. That is room to decrease borrowing. That's positive. But ultimately, what the negative side, and I think what you need to keep in mind is that, yes, economic support measures decrease the cost on the economy, but ultimately borrowing is just pulling future consumption forward. And that's what we're doing. We need to pay it back. And that is going to be, this borrowing now is going to become a cost in the future. So on a multi-year view, we're at this point where we're just doubling up on the cost of COVID restrictions. And that is not great. So this effectively tells us, you know, from a fiscal perspective, the sooner we can relax restrictions, obviously subject to, you know, your social constraints like minimizing deaths or trying to get the deaths because of COVID to zero, the sooner we can do it, the better.
I suppose, Walt, you mentioned the excess borrowing there, but if you put yourself in National Treasury shoes, is there any reason why they have done this?
We've been debating for hours around this, and Rizwana has been breaking her head about why they're doing it, right? And there's a couple of reasons we think, right? So there's obviously you know, a lot of gaps that needs to be filled, especially in the SOE space, and you know, there might be other unforeseen expenditures that we don't know of. And, you know, we also know there's quite a lot of debt that needs to be rolled. But apart from the SOEs that needs to be supported, you know, we don't think there's necessarily any other good reasons why you want to borrow at expensive rates and then just sit on the cash. So we don't think it makes a lot of sense. And, you know, we continue to think that, you know, if restrictions are going to be relaxed steadily over the next couple of months, there's no reason why they should slow the borrowing as well.
Yeah. And then Walt, maybe just on thoughts going forward here, and the economic support that is potentially available. What are your thoughts on that?
So, look, we all know it's not available, right? I mean, from a fiscal perspective, South Africa cannot continue to spend at the pace that we are spending. You know, I guess in theory, you can spend, you know, up until the market actually tells you that you can't anymore. But as I've mentioned, ultimately it's a cost. So, you know, South Africa has to double up on these economic support measures and spend another 6-7% of GDP this year on only economic support measures. not even on all the other stuff, we're going to run into big problems. So I would say, there's not a lot of room to continue these things over and above the next, 3 or 4 months that we might have before vaccine rollout is in full swing.
And Walter, I suppose the question that a lot of our clients are very interested in is just the impact of these restrictions on individual sectors. Is there anything in your work that can provide a little bit of clarity on the sector impact?
Yeah, exactly. So absolutely right. I mean, so us, when we are generally interested in the macro stuff at the top, simply because that's where we think about around the budget and the fixed income. But I think the more interesting, the exciting stuff is in the different sectors. And we've done a bit of work on it, not necessarily in the research that we've released so far, but we're certainly going to do more in the next week or so. And as I've mentioned, right, I mean, we need to turn this out, I think, sooner rather than later, because it doesn't help that we kind of look at it, in December, in December of this year, look back and say, well, okay, this is what happened. That's not going to help anybody. And there's very interesting things coming out with some of the stuff that we've done, and I've just put on retail sales and manufacturing here, for example, the sectors, and some of the initial findings that we've done. And if you look at retail, for example, so a very similar type of analysis that we've done. We look at the retail sales in South Africa, and then look at how has restrictions affected retail sales, what has been the economic support measures, how strong has that been, and then also there's other sub-indices that we can also look at for that might be of interest to specific sectors. Like, for example, the retail sector, would be quite adversely affected by the restrictions of movement. People can't go to the beach, which implies they won't buy ice creams and all the other stuff, or people just can't go to the shops because of curfews between 7 and 7. So once we start analyzing that, you can see that if you look at retail sales specifically, the gross cost has not been that high. And when I say gross cost, the overall restrictions. And you can also see from the retail sector, it appears as if the economic support sectors has actually been quite strong, which to us makes sense, right? I mean, if you're going to pay this, a large part of your economic support into social grants, and people are going to spend it, it should almost have in theory at least, almost a one-to-one effect on retail sales if they're going to spend it on food and clothing, etc. So I think that's why it's so strong. But you can also see, for example, restriction of movement had quite a big negative effect on retail. Now, if you go and you look at, for example, manufacturing on the opposite side, the economic support measures had a substantially smaller impact relative to the gross cost. And some of the work, we found that not necessarily. It's still very, it's not final results, but what we found is that, for example, the restriction of movement didn't necessarily affect manufacturing that much, or at least statistically significant. But it definitely, the overall restrictions, and I think ultimately demand affected manufacturing quite stringently. And you can see if you look at the net effect, retail sales seems to be almost back. Even the January restrictions didn't have any effect on retail sales because of the economic support measures. But if you look at manufacturing, it seems as if it's going to have quite a big effect in our view. Now, for us, the interesting part comes in, and this is actually where I think government actually needs to get their act together, and they need to start thinking about these type of things in this type of way, kind of smart restrictions, if we need to go down the next wave. And you look at, for example, how retail sales is reacting. Big bonus or big plus for retail from economic support measures. But if you can in some way do away with restriction of movement, then you can also offset some of the support measures, and the retail sales will still be on a net basis unaffected. And then you can use that money that you've used for example, for direct grants, and try in some way to channel it towards, for example, a manufacturing sector. And that would obviously then help the manufacturing sector better. because if you do away with restrictions of movements, the retail sector, for example, wouldn't necessarily need all the support they need. So those are the type of things I think we can do, and government should do, and then obviously also for our clients, we can obviously tell them, look, almost on a real basis, we think this type of restrictions are going to affect the sector in X, Y, and Z. We're still kind of starting to scrape the surface here, but there's definitely some interesting results to be had.
Yeah, that's really interesting. Thanks, Walt. I think I've got a couple more questions here from the audience. Yeah, this is one that leads through to some of our estimates. Inflation. So what does restrictions mean for prices and inflation? And then maybe I'll split it out, Walt, into the short term and then maybe your longer term view on it.
Yeah. So look, I mean, restrictions. If we think about restrictions, at least kind of first round effects, for us, to keep it simple, means lower demand, and obviously lower demand means less demand pull pressure on inflation. So for us, if we continue to see restrictions higher rather than lower than expectations, we think that the inflation will also surprise on the downside. We've got our inflation, maybe just put that in perspective, we've got inflation for 2021 at 3.9%, and firmly biased for that is for us lower than rather than higher. That's a first round effect. I think once you start thinking second round effects and maybe longer term, I would actually be concerned that it will put upward pressure on prices, and not necessarily because demand is going to be so strong, but I think we might run into potentially into some supply issues, because what is very likely to happen, and I think is happening already, is we're obviously decreasing the supply base in the economy. The longer the restrictions are in place, the longer or more firms fall out of the supply curve, and you actually get increased or less supply to the economy as a whole, which means higher prices, a concentration in different sectors, which gives higher pricing power to a few firms. So that's effectively how we would think about it. But short term in a 12-month view, I think biased to the downside for us.
Thanks, Walt. And maybe just another question from the audience. I think if we just go a few slides back, guys, to the one where we had the monthly movement or the monthly costs. I think the question was just around April, that there seemed to be stimulus being put forward in April, but the impact to the economy was still quite large.
Yeah, so maybe if we just move here, so exactly right. So the stimulus so you also have to remember, if you go back, and I mean this is obviously also based on the data from the University of Oxford. But absolutely. So we had the restrictions and the strict restrictions, the most stringent restrictions being put in place in April. But the rollout of the economic stimulus was one, either not in full swing yet, and secondly, or alternatively, people haven't taken it up yet. And that's why obviously the bang to the economy was in April, May, and then to a lesser extent June. We had, because you have to remember, right? I mean, and if you cast your mind back, right? I mean, we all lived it, obviously. I mean, government was very quick governments across the world very quick to implement restrictions, and then almost after the fact they started thinking about, okay, let's roll out the stimulus, and I think that's why we are seeing this lag effect. The good news, I guess, is if the stimulus continues for a month or two more and restrictions reduce, then we're going to see something like we've seen in October, November, where we see a big positive from the support relative to the restrictions.
Well, maybe if I just ask you on, if we take a step back and go to March, April, when this was starting, do you think this chart reflects what was expected in terms of the stimulus going in and the impact? I mean, it obviously looks like if you lock down quite aggressively but put stimulus in, it doesn't really make a difference. But once you start opening up a bit, that starts coming through. And as you mentioned earlier, Well, once the economy starts opening up more, it has a disproportionate impact on growth.
Look, I mean, I honestly, I think it does have a disproportionate impact, right? Because as I said, the stimulus is generally constant versus the restrictions which change over time. So that just makes complete sense. But I think there's a couple of things, and unfortunately, this is where only time will tell. And when we look back, it might actually happen that so there's stimulus in place and it is recorded as, for example, June in the data, but individuals can only decide to spend it in July or August, right? So in reality, the stimulus or the economic support is spread differently from what the data suggests. So that's definitely one of the things which could happen, no doubt, and which I think we need to be kind of keep in mind. But as I said, unfortunately, time will tell, and when we look back on that. And I think the second thing is and this is what some of the sector work that our initial sector work is showing. The stimulus is obviously also spread unevenly across sectors. So you might work or live in one sector and it feels as if there's no support, and then you actually realize, and somebody else in another sector feels that things aren't going that bad. I think that's also a reality. And as I've mentioned, depending also on how the restrictions are put in place, right, the movement of people affect some sectors disproportionately, which might kind of make it feel as if the economic support measures doesn't work at all. So I think all of these things need to keep in mind, but at an aggregate level, we're comfortable with this result. It gives us at least some estimate on a timely basis.
Thanks, Walt. I think we've got 3 or 4 minutes left. I've just got 2 more questions. The first one from the audience. I'm going to have to ask you to put on your political health hat a little bit here, Walt. I'm going to read it out. With ex-President Zuma expressing a strong view of ignoring an order from the Concord, the Land Appropriations Bill getting more attention again and not in a good way, and the unshameful publicity of government incompetence and corruption, do you think that South Africa can remain an attractive investor destination?
So I don't have my political hat here. So look, the short answer is yes, absolutely. I think it's possible. Once again, as I've mentioned, and you actually realize, once you've lived in different places across the world and you've observed how different economies also work, what's happening in South Africa is not, it's politically, or from a political economy perspective, I should say, it's not positive, and you can't condone it, definitely not. But it's happening all over the world, and I think sometimes us as South Africans forget that. That's the important thing. And as I've mentioned, you sit with a relative gain here. If it happens all over the world, then maybe South Africa in a relative basis is not that bad off. And from that perspective, I think one can remain an attractive destination. What concerns me, and what I think will hamper investments in the long run, is property rights. And that to me is the cornerstone. And not to me, empirical studies and studies that academic studies has shown it time and over again, is that property rights are the cornerstone of welfare in the welfare of any economy. If you don't have that, then you're going to struggle. So politics, could be bad, but it's noise. It happens everywhere. Property rights specifically, I think, should be a concern.
Thanks very much, Walt. That was very well answered to that bouncer that was thrown at you there. I think just to end it off, Walt, maybe just give us your summary. What have you learned from the work that you've done here, and potentially what's next? What are some of the questions that you still think you can tackle?
Yeah. So first of all, right. The key for us is that we think it's able to get a monthly, almost real-time estimate of what it would cost the economy. Might not be 100% correct, but we think it's good enough to get some indication, which can be used, get a sense of how it's going to be the impact. And as I said, the restrictions we've seen in January has been large. We should try to avoid it. That's the first thing. The second thing is, I honestly think government should start thinking about, now that we've got enough data, they should start thinking about not imposing blanket restrictions in a similar way that they've done in the past. We should analyze the data and start implementing smart restrictions that favor sectors that don't react well to these restrictions. And it can be done. As I've mentioned, you obviously want to keep in mind, actually what you want to achieve, and that is to minimize deaths. That is obviously the kind of binding constraint. And then thirdly, I think what is nice is, we shouldn't despair because South Africa is not an outlier. For me, that's quite important. And I think it also implies something for our asset prices. And then lastly, what we've seen, and if you think about the vaccine rollout and the cost to the economy, ultimately, any country, South Africa specifically, should get the vaccine out as soon as possible. If it costs us 40 billion and January restrictions alone cost us 27 billion, then it's a no-brainer, right? You want to get it out as soon as possible to lift these things so that we can go about our business.
Thanks so much, Walt. I think we've reached the end of our time. As always, great chatting to you. Love the data behind it. Love the logical conclusions that you're coming up with, and I'm sure there's a lot more work that is going to be done on the back of this. To everyone that's listened in, thanks very much for joining us. As always, any questions, any comments, any feedback, please pop us a mail or give us a shout. Thanks, everyone. Have a good afternoon. Bye.
Thanks, everybody.